Vinit Bolinjkar, Head of Research with Ventura Securities, joins us now to get a view on where Honasa or Mamaearth listing should list and what is a good time to buy. So Vinit, अच्छा है मगर महंगा है. Can I say that for Honasa?
अच्छा है पर महंगा है, पर ग्रोथ उससे और अच्छा है.
So what
तो
should
जस्टिफाई.
so what should one do? I mean, you can look at it and say, okay, it's a small business, but a very niche player. They've created a great brand. Growth is high. But if one is looking at buying it today, do you think in the future, do you think future returns will be compromised, or at this price also for a 2-3 year view, it's a fair deal?
I think it is a fair deal, and I'll give a rationale for that. Is that the stock is justifying a growth of more than 30% in top line, and faster trajectory in the margins. And we have seen the margins pick up, 2% last year, 6% Q1. So the trend is definitely there that the path to profitability is being established. It's not established, it's being established. And we see drivers out there, and a 20 and a brand which has grown in 5 years to be one of the largest brands. I think that definitely it makes sense to buy this stock. And their offline portfolio, which is around 35%, top three brands which are over 100 crores. So, your Mamaearth is 1400 crores, your Derma company is 300 crores, your the other brand is 150 crores, and the two new brands which they've acquired have got global appeal, and definitely they can easily grow them because they simply have to replicate the kind of work that they're doing. So, given all these uh, expectations, I believe that the company offers a veritable play to enter the segment and buy into it. Additionally, if you see the global metrics are very strong. India has the highest growth rate, lowest penetration for the BPC space. Also on the e-commerce space, we are the one of the lowest penetrated and the fastest growing. So all these add up to a very stable, good portfolio, which should help enable the company grow very quickly. And to my mind, a 28 to 30% growth is not difficult, given the fact that it's a fledgling company in a large space which is growing very fast and has got excellent market recall.
But Vinit, is it the right price currently around the issue price to actually buy into? I mean, how is it? What would you say is a fair value really for this business? While you do see growth in the longer run, what's the price you're willing to pay?
So I think I will buy at current valuations and add down lower. I'm not going the whole hog into the company right at the current price. But if the price does correct, I'm definitely going to sip into the counter.
In fact, we are getting those live visuals as well from the NSE. Well, any minute the bell ringing is going to take place, and we will cut across to those visuals as well. But Vinith, what would you say is the closest competitor to the brands Honasa actually owns? Namely, of course, the more popular one being a Mamaearth. And how do the valuations stack up amongst the peer group, you would think?
Right now it's difficult to give a call purely on the numbers which are there, and I don't want to give you a metric purely based on the EV to sales because the dynamics can change as the profitability kinds of builds up. So I think 10,000. Right now at this current pricing, it definitely looks very very decent to get into the stock at current levels.
Vinit, some would say, look, I bought into Zomato because it was niche. Paytm was great because it was high growth and a very niche fintech, model. But with Honasa, A, it's in a competitive space. B, it's a space where incumbents have a far bigger reach and far bigger say. They managed to grow their balance sheet by having 35% of its revenue spent in advertising. So when it comes to competing with big boys, where balance sheets and reach is much stronger, can Honasa and Mamaearth really grow that well?
So, we have to just measure the pace of the growth of the brand by itself. So, what Dove did in 18 years, as they say in their report, Honasa has done it in 5 years, or Mamaearth. as a 1400 crore, 1000 crore plus brand. So definitely the brand is well known. It's a very, very premium brand. And there is an increasing tendency among the Uber Neo crowd to go and pick, concentrate stories which are very niche in nature. And to my mind, I think there is ample space for niche brands to exist and coexist with other players. And when you're going online, the difference between these two is obviously the traditional category of FMCG brands and the neo brands which are there is kind of obliterated. So you are on a equal footing with them as long as you are doing your spend as well. And while Honasa has been a digitally first enabled brand, their uh, the retail part or the offline portfolio is also growing very fast. So it is almost 35%. So, they have been able to grow both their digital as well as the offline piece very well and continue to manage the growth. And, speaking about the gross margins at 72%, they are one of the best plays out there. So, with a high, despite the premium pricing, aggressive gross profit margins among all the other companies in the listed space, I think their path to profitability will be much faster.
All right.